Two neighbors living side by side for over 200 years. They share the same climate, similar economies, and even fight the same wars together. But here's where it gets bizarre. One neighbor suffers through 17 devastating banking crises that destroy millions of lives and wipe out trillions in wealth. The other? Zero. Not one. Not even close. This is the United States and Canada. And if you think you know why Canada avoided every banking crisis that crushed its southern neighbor, you're probably wrong. The conventional wisdom says it's because Canadians are more conservative, more boring, more risk-averse. But here's the thing, that's complete nonsense. French Canadians tried to start a revolution in the 1830s. There was almost an Irish invasion of Canada from the US in 1865. These aren't exactly the actions of a boring, risk-averse people. The real answer reveals something terrifying about how political systems can trap entire nations into cycles of financial destruction for centuries. By the end of this video, you'll understand why the United States, despite being aware of Canada's success for over 200 years, couldn't escape its own banking hell. Let's start with some numbers that will make your head spin. From 1790 to 2010, the United States experienced 17 major banking crises. Canada experienced zero. But here's what makes this even more mind-blowing. Both countries' economies tracked each other almost perfectly throughout this entire period. Look at this data from 1952 to 1980 during the Great Inflationary Period. Canada and the US had nearly identical price growth patterns. They're neighbors, they trade with each other constantly. They experience the same external shocks. By every economic theory, they should have had similar banking experiences. But they didn't. Not even close. During the most recent financial crisis period from 1970 to 2013, which experts call the most unstable era for banking in all of world history, just 18% of all countries had two or more major banking crises. Most had one crisis, and nearly a third had none at all. In that zero crisis category, you'll find Australia, New Zealand, Canada, Hong Kong, Singapore, and Malta. Developed, sophisticated economies with mature financial systems. In the two crisis category, Democratic Republic of Congo, Chad, Argentina, and the United States of America. The US is the only mature, developed economy that belongs in the same category as some of the world's most economically unstable nations. But here's the most disturbing part. It's not that Americans didn't know. They knew exactly what Canada was doing right. In 1910, after the devastating panic of 1907, the U.S. established the National Monetary Commissions specifically to study why other countries' banking systems worked better than America's. They commissioned dozens of books by the world's leading banking experts. 3 entire books just about Canada. These books identified exactly what made Canada's system superior. The Commission understood perfectly why the U.S. banking system was crisis-prone. When they made their recommendations to Congress, did they mention the key difference that was causing all the trouble? No, they completely ignored it. It would be like going to a doctor with cancer, and the doctor saying, "I see you have the beginning of a bunion on your foot. Let's fix that." Meanwhile, the cancer continues to spread. This isn't a story about economics. This is a story about power, politics, and how certain groups can capture an entire nation's financial system and hold it hostage for centuries, even when everyone knows there's a better way. To understand how these two neighboring countries ended up on such different paths, we need to go back to their origins. The key lies in something most people never consider: geography and constitutional structure. The United States developed with a vertical orientation. The original colonies stretched along the Atlantic coast from north to south. The country's early economic development was focused on accessing Atlantic trade routes and expanding westward across a continent. Canada developed with a horizontal orientation. Most of the economic activity was concentrated within 100 miles of the U.S. border, particularly around the Great Lakes region. Much of Canada's vast northern territory was essentially uninhabitable wilderness. This geographical difference shaped everything that followed. But the real divergence came down to constitutional structure and political power. Both countries had rural populist movements that distrusted big banks and Wall Street financiers. But here's the crucial difference. The structure of the Canadian Constitution didn't allow rural populists to win the political battle over banking. The structure of the U.S. Constitution did. In Canada, banking regulation was a federal responsibility. The federal government in Ottawa could override local opposition and create a national banking system with large, diversified banks that could operate across the entire country. In the United States, banking regulation was split between state and federal authorities. Individual states controlled state-chartered banks within their borders, while the federal government controlled nationally chartered banks. But even national banks were severely restricted by state-level political pressure. This created a system where rural populist movements could block the creation of large, branching banks state by state. And that's exactly what they did. The result was something called unit banking, a system where most banks in America were restricted to operating from a single location. One office, one town, that's it. Imagine you're a bank in Champaign-Urbana, Illinois in 1920. You can only operate from your one headquarters building. All your loans have to be made from that office. All your depositors have to come to that one location. And what are the two main industries in Champaign-Urbana? Soybeans and corn. So every single loan you make is tied to the price of soybeans and corn. Every business in town depends on farmers who grow soybeans and corn. When commodity prices fall, land values collapse, farmers default, businesses fail, and your bank goes under. A Canadian bank, by contrast, could have branches in farming communities, manufacturing cities, mining towns, and fishing ports. When one region struggled, profits from other regions could absorb the losses. When one industry collapsed, the bank was diversified across dozens of industries. It's like the difference between putting all your money in one stock versus buying an index fund. The risk reduction from diversification is enormous. But unit banking created a second, even more deadly problem: coordination failure. Imagine you're a Canadian banker in 1890 and a financial shock hits the economy. How many other bankers do you need to get in a room to coordinate a response? Maybe 5, maybe 12, at most 20. All the major Canadian banks operated nationwide. They knew each other personally. When crisis threatened, they could quickly assess which banks were genuinely in trouble and which were just facing temporary liquidity problems. Sometimes they would coordinate to acquire a failing bank before it collapsed, sharing the losses among themselves to prevent panic from spreading to the entire system. Other times, they would let a bank fail, but coordinate their communication to ensure depositors understood that the failure was isolated and wouldn't spread. Now imagine you're an American banker in 1890. There are 20,000 banks scattered across the country, each operating from a single location. A financial shock hits. How do you coordinate with 20,000 other banks, most of whose names you don't even know? You can't. Coordination is impossible. So when shocks hit the American banking system, panic would spread from bank to bank like wildfire. This coordination failure turned manageable problems into nationwide catastrophes. Over and over again. Here's what makes this story so maddening. American banks knew they were more vulnerable. Look at the balance sheet ratios. U.S. banks held 45% of their assets in cash compared to just 27% for Canadian banks. U.S. banks maintained equity ratios of 20% compared to 19% for Canadian banks. American banks were holding more cash and more capital as a buffer against the instability they knew they faced. But even with these higher safety margins, they were still more crisis-prone than their Canadian counterparts. The Canadian banks could afford to be more leveraged and hold less cash because they were genuinely safer due to diversification and coordination capabilities. This made Canadian banks more profitable and efficient, not just more stable. Remember the National Monetary Commission of 1910? After the panic of 1907 devastated the U.S. economy, they clearly identified unit banking as the fundamental cause of American banking instability. They understood that the lack of diversification made individual banks vulnerable, and the inability to coordinate made the entire system vulnerable. Their solution? Don't mention unit banking at all in their final recommendations. Instead, they focused on creating the Federal Reserve System to serve as a lender of last resort. Why would they ignore the root cause they had clearly identified? Politics. By 1910, opposition to branch banking had become deeply embedded in American political culture, especially in rural areas. The populist movement, led by figures like William Jennings Bryan, made the preservation of unit banking one of their core political platforms. When Illinois held a referendum in the 1920s asking whether to relax unit banking restrictions, it lost. Voters chose to keep the system that was destroying their own banks. This seems completely irrational until you understand the political logic. Rural voters saw unit banking as a form of credit insurance. Yes, in really bad economic conditions, their local bank might fail entirely, leaving them without any credit. But in moderately bad conditions, say when soybean prices fell but didn't collapse, their local bank had no choice but to keep lending to them because they were the only game in town. In a branching system, a large, diversified bank might decide that agriculture in their particular region had become too risky and cut off credit during moderate downturns. The geographic concentration of unit banking tied banks to their local communities in ways that could benefit borrowers during normal times. So rural voters were making a rational choice. They preferred a system that gave them guaranteed credit during moderate crises, even if it meant catastrophic credit collapse during severe crises. The problem is that this individual rationality created collective irrationality. The unit banking system didn't just hurt the banks, it made the entire economy more unstable, ultimately hurting everyone, including the rural voters who supported it. From roughly 1815 to 1980, 165 years, the United States maintained a banking system that everyone knew was inferior because it served narrow political interests. During this entire period, political power was dominated by agrarian populism, a coalition of farmers and small-town interests that favored unit banking, opposed Wall Street, and generally distrusted large financial institutions. Meanwhile, Canada developed one of the most sophisticated and stable banking systems in the world. By the 1990s, Canada was actually providing more credit to its economy than the United States, despite having a more conservative regulatory approach. So Canada achieved the holy grail of banking: more credit, more innovation, and more stability, all at the same time. The stranglehold of agrarian populism finally broke around 1980, but this created new problems rather than solving old ones. After 1980, the United States finally began dismantling unit banking restrictions. Banks were gradually allowed to open branches within states, then across state lines. But instead of achieving Canadian-style stability, the U.S. banking system found new ways to create instability. The political coalition that replaced agrarian populism had its own priorities that often conflicted with banking stability. The new urban coalition was heavily focused on expanding home ownership and making credit accessible to previously excluded groups. Government-sponsored enterprises like Fannie Mae and Freddie Mac, along with various affordable housing mandates and mortgage subsidies, created enormous concentrations of real estate risk in the banking system. By 2008, this risk had grown so large that it nearly destroyed the global financial system. So the United States finally solved its unit banking problem, only to create a massive real estate bubble problem. Different decade, different crisis, same underlying issue: political interference with banking markets in pursuit of narrow constituency goals. Canada, meanwhile, maintained its traditional approach of allowing banks to operate efficiently while avoiding government subsidies that encouraged excessive risk-taking. Canadian banks were barely affected by the 2008 crisis that devastated their American counterparts. We're currently living through what banking historians consider the most unstable period for financial systems in all of world history. Since 1980, there have been over 100 major banking crises worldwide. Compare that to the period from 1874 to 1913, when there were only 10 crises globally, and most of those were relatively mild. What changed? not the fundamental structure of banking. What changed was the political environment. Governments around the world began intervening more heavily in banking markets, often with good intentions, but terrible consequences. The pattern repeats across countries and decades. Political interventions designed to solve specific problems create new forms of systemic instability that often prove even more destructive than the original problems. Looking at the current global financial system, several warning signs suggest that we may be heading toward another major period of instability. Debt levels have reached record highs in most developed countries. Central banks have held interest rates near zero for over a decade, encouraging risk-taking and asset price bubbles. Government intervention in financial markets has reached levels not seen since the 1970s. Most ominously, political polarization is increasing in most democracies, making it harder to maintain technocratic approaches to financial regulation. Populist movements on both the left and right are demanding more government intervention in banking and finance, often with little understanding of the systemic risks these interventions create. The European banking system remains fragmented and vulnerable to sovereign debt crises. China's debt burden continues to grow at unsustainable rates. Even Canada is showing signs of housing market instability that could threaten its banking system. The conditions that led to stable banking systems in the mid-20th century, strong institutions, technocratic regulation, international cooperation, are eroding around the world. After examining 200 years of divergent banking experiences between Canada and the United States, three crucial lessons emerge. The difference between centralized and fragmented banking regulation isn't just a technical detail. It's the difference between stability and chaos. Canada's centralized federal control over banking allowed it to maintain large, diversified banks that could weather any storm. America's fragmented state-federal system created thousands of small, vulnerable banks that failed repeatedly. How you structure political power over banking matters more than almost any other policy choice. For 165 years, American rural populists successfully maintained a banking system they knew was inferior because it served their immediate political interests. They got guaranteed local credit during moderate crises in exchange for catastrophic system-wide collapses during major crises. This wasn't stupidity, it was rational political behavior that produced irrational economic outcomes. Every democracy faces this same tension between what's politically popular and what's economically optimal. American officials knew exactly what was wrong with their banking system and exactly how to fix it. The 1910 National Monetary Commission understood everything. But knowledge without the political power to act on it is worthless. This is why financial crises keep happening even as our technical understanding improves. The problem isn't lack of knowledge, it's the political impossibility of implementing solutions that threaten entrenched interests. Here's what should terrify you. We're living through the most financially unstable period in human history, and the same political forces that trapped America in 165 years of banking hell are stronger today than ever. Governments around the world are intervening more heavily in financial markets, often with good intentions but catastrophic results. Populist movements are demanding more political control over banking, ignoring the lessons of history. International cooperation is breaking down just when we need it most. The Canadian model shows that stable banking is possible, but it requires political systems capable of resisting short-term pressures in favor of long-term stability. How many democracies today have that kind of institutional strength? We know what works. The question is whether we're capable of implementing it before the next crisis destroys what we've built. The choice is ours. We can learn from Canada's success and build more stable financial systems. Or we can repeat America's historical mistakes on a global scale. Which path do you think we're on? If this story has opened your eyes to how political systems shape financial stability, then you need to understand what's happening in your own country's banking system. Are your banks diversified or concentrated? Is regulation centralized or fragmented? What political pressures are building that might create the next crisis? The most important financial decision you can make isn't which stocks to buy or which bank to use. It's understanding how political power shapes the system that holds your money. Subscribe and hit the notification bell if you want to dive deeper into how political forces create and destroy wealth across centuries. Because once you see these patterns, you can't unsee them. And they're everywhere. Next week, we're going to explore how the same forces that created America's banking crisis pattern are now reshaping global cryptocurrency markets. You won't believe how history is repeating itself in digital form. Until then, ask yourself this question. If your neighbor had a perfect lawn for 200 years while yours kept dying, how long would it take you to ask what fertilizer they were using? America took 165 years to ask Canada that question. How long will it take you?